Japan's financial foundations are cracking in ways that threaten to shake the entire architecture of global capital flows, and that tremor is already reverberating through the prices of gold and silver. For decades, the quiet machinery of Japanese savings has underwritten stock markets, bond auctions, and portfolios across the Western world. Now that machinery is being deliberately reversed, and the consequences for every asset class, including the monetary metals, are only beginning to surface. The Japanese currency has slid to depths against the dollar last witnessed when Reagan occupied the White House and Nintendo still felt like science fiction. 40 years of relative stability have given way to a yen that now requires more than 160 units to purchase a single greenback. At the same time, yields on Japanese government debt have climbed with a speed usually reserved for emerging market distress. The 10-year note, once content with 0.25%, now demands nearly 3%. The 30-year maturity has crossed 4%. In a nation whose public liabilities exceed 200% of economic output, each additional basis point translates into mountains of new interest expense. This combination, collapsing currency and rising sovereign yields, should be impossible for the world's largest creditor nation, yet it is unfolding in plain sight. What makes the episode so consequential for gold and silver markets is the sheer scale of capital that has long been borrowed in yen and deployed everywhere else. For roughly 3 decades, Japanese interest rates sat at or near zero, while the rest of the developed world offered higher returns. Hedge funds, banks, and institutional investors discovered they could borrow yen for almost nothing, convert the proceeds into dollars or euros, and purchase anything that paid a positive yield. United States treasuries, technology equities, corporate credit, even digital assets. The resulting carry trade ballooned into the trillions. Simultaneously, Japanese households, insurers, and the enormous government pension investment fund shipped their own savings abroad in search of income that no longer existed at home. Japan became the single largest foreign owner of American government debt, holding well over $1 trillion of treasuries alone, plus hundreds of billions more in equities. Every time American stocks advanced or Bitcoin rallied, a quiet portion of the fuel came from yen-denominated leverage or Japanese portfolio allocations. That arrangement rested on one fragile premise. Japanese rates would remain near zero forever. Inflation finally returned after the pandemic, supply chain ruptures, and energy shocks. Japanese consumer prices climbed above 2% for the first time in a generation. Workers who had accepted stagnant wages for 30 years began demanding and receiving the largest pay increases in decades. Energy costs spiked further with Middle Eastern conflict. A new administration in Tokyo signaled readiness to expand fiscal outlays, which meant issuing still more bonds into an already saturated market. Suddenly, the Bank of Japan faced an impossible choice. Keep rates at zero and watch the yen evaporate, or raise rates and force the government and the central bank itself to service a debt mountain at real cost. They attempted a middle path, modest rate increases, coupled with heavy currency intervention, and obtained the worst of both worlds. $73 billion of reserves were spent buying yen in the spring. The currency stabilized for a few weeks and then resumed its descent. Rates were lifted to 1% a level unseen since the mid-1990s, yet the yen continued to weaken. Bond yields, meanwhile, kept climbing because the market no longer believes the central bank will remain the buyer of last resort. The Bank of Japan already owns nearly half of all outstanding Japanese government bonds. Japanese insurers and banks hold most of the rest. Foreign ownership is under 8%. When the official buyer steps back while the government plans to issue more paper, private investors demand higher compensation for the risk. That is precisely what is occurring. The same dynamics are visible in positioning data. Speculative accounts have amassed one of the largest short positions against the yen in 18 years of recorded history, roughly $11 or $12 billion of visible futures, and almost certainly far more in the opaque over-the-counter market. Every intervention that fails simply feeds the shorts additional liquidity. Japanese officials appear to have concluded that defending the currency by purchasing it is futile. The only durable solution is to change the location of Japanese capital itself. Repatriation is the technical term, and the process has already begun. For the first time in a generation, domestic Japanese bonds offer a yield that can compete with foreign alternatives once currency risk is considered. The 30-year note at 4% looks attractive to a Japanese insurer or pension fund that can earn the coupon in its home currency without exchange rate exposure. On the 10th of July, the Finance Ministry publicly encouraged the Government Pension Investment Fund, the largest such pool on earth, valued at roughly $1.8 trillion, to shift allocations away from foreign assets and toward Japanese ones. That single fund holds approximately $230 billion of United States treasuries plus substantial equity holdings. When the instruction was issued, the yen strengthened and Japanese bond yields fell sharply, the largest one-month decline in recent memory. Insurance companies have already reversed course. After 2 years of net selling of long-term Japanese government bonds, the most recent data show the largest purchases in 3 years. Where did the cash originate? In large part from sales of United States treasuries. Dollars are converted into yen. The yen finds a buyer. Japanese bonds find a buyer. American bonds find a seller. The world's most reliable foreign customer at treasury auctions is stepping back and perhaps beginning to liquidate. Fewer foreign bids mean the United States must offer higher yields to clear the market. That pressure is already visible in the 10-year Treasury note hovering near 4.7%. Levels that directly influence 30-year mortgage rates for American households. Even an investor who has never purchased a Japanese asset is paying part of the cost through higher borrowing costs at home. The same logic extends to gold and silver. A sustained retreat of Japanese capital from global risk assets tends to elevate demand for monetary metals. When leverage is unwound and liquidity contracts, gold historically benefits as a store of value that requires no counterparty. Silver, with its dual monetary and industrial character, often amplifies the move. Periods of yen strength have repeatedly coincided with stress in leveraged markets. In 1998, a 15% yen rally in 3 days accompanied the collapse of a major hedge fund whose carry trade positions required Federal Reserve coordination to contain. In 2008, The yen climbed throughout the year as the global financial crisis unfolded. In 2011, 2016, and March of 2020, the same pattern appeared. Rapid yen appreciation marked moments of acute risk aversion. In August of 2024, a mere quarter-point rate increased by the Bank of Japan triggered a 12% drop in Japanese equities, the worst single day since 1987, and a 3% decline in American stocks, all while most participants had no idea the catalyst was Japanese. The yen functions as a real-time gauge of global leverage. When that gauge moves sharply higher, gold and silver typically find support. What distinguishes the present episode is intent. Previous yen rallies were involuntary side effects of crisis. This time, Japanese policy appears deliberately aimed at a stronger currency. Rate hikes, official encouragement of capital repatriation, and quieter regulatory measures all point in the same direction. One measure circulating in market discussion is the potential invocation of Article 589 of the Japanese Civil Code, which governs the charging of interest, and could, in theory, give authorities greater influence over the terms under which yen credit is extended abroad. No formal policy announcement has confirmed such use, and skepticism remains warranted. Yet the mere discussion underscores the determination to reverse capital outflows. Parallel incentives are being constructed in the digital asset sphere. Japan has enacted legislation that classifies certain crypto assets as financial instruments, permitting banks to hold them, and proposing a sharp reduction in the tax rate applied to crypto gains, from 55% to 20%, provided the assets reside on domestic, regulated platforms denominated in yen. The motive is not speculative enthusiasm. It is the creation of a domestic channel that can absorb Japanese government bonds as collateral for yen-denominated stablecoins. American stablecoin issuers have already become among the largest private holders of United States treasuries because every digital dollar must be backed one-for-one by high-quality assets. Japan is examining the same model as a potential buyer of last resort for its own enormous debt stock. Capital that once fled offshore in search of yield may now find regulated, tax-advantaged, yen-based vehicles at home. If these efforts succeed and the yen begins a sustained recovery, the unwind of the carry trade will not be confined to currency markets. Positions financed by cheap yen will face rising funding costs or outright margin calls. Equity markets that have enjoyed years of Japanese portfolio inflows will confront a large and sudden seller. Credit spreads may widen. In that environment, gold's role as an unencumbered monetary asset becomes more prominent, while silver's volatility can attract both industrial users seeking physical metal and investors seeking leveraged exposure to the same monetary impulse. The scale of the potential adjustment is difficult to overstate. Japanese external assets accumulated over decades represent one of the largest concentrated pools of capital in the world. Their gradual or abrupt return home would reverse a multi-decade subsidy to global risk assets. American mortgage rates, corporate borrowing costs, and equity valuations all embed assumptions about continued Japanese demand for dollar assets. Those assumptions are now in question. Gold and silver markets, by contrast, have no such dependency. They stand outside the credit system and therefore tend to gain relative appeal precisely when that system is stressed. None of this implies a predetermined outcome. Currency interventions can still be mounted. Domestic political priorities may shift. Global growth or inflation surprises could alter the relative attractiveness of Japanese assets. Yet the direction of travel is clear. Japanese policymakers have chosen to prioritize currency stability and domestic capital retention over the previous regime of ultra-low rates and export of savings. The bond market is already pricing higher term premia. The currency market is testing multi-decade extremes. Speculative positioning remains heavily skewed against the yen, and the largest domestic institutional investors have received an unmistakable signal to bring capital home. For participants in the gold and silver markets, the implication is straightforward. Periods of forced deleveraging and capital repatriation have historically supported higher precious metal prices measured in both dollars and yen. Physical demand from Asian central banks and private investors already provides a firm floor. Any acceleration of Japanese selling of foreign assets or any disorderly rise in global yields triggered by the withdrawal of a major buyer would likely reinforce that bid. Silver's tighter supply dynamics and industrial offtake add a second layer of support once monetary demand intensifies. The story is still unfolding. Yields continue to grind higher even as headline inflation has eased below the Bank of Japan's 2% target for several consecutive months, an inversion of the usual relationship that signals the market is pricing supply risk rather than inflation risk. Equity markets in Tokyo have experienced sharp single-day declines on relatively modest policy shifts. Foreign exchange reserves remain large enough for additional interventions, yet officials appear reluctant to expend them in a manner that merely rewards short sellers. The preference for structural solutions, rate normalization, capital repatriation, regulatory incentives suggest a longer-term commitment rather than temporary firefighting. In the gold and silver complex, these developments are being monitored with heightened attention. Lease rates, exchange inventories, and the shape of the forward curve already reflect elevated caution. Open interest in futures has shifted toward longer-dated contracts as participants seek protection against multi-year rather than multi-week volatility. Central bank purchasing, particularly in Asia, continues at a pace that absorbs a meaningful share of our annual mine supply. Any sustained yen appreciation that coincides with broader risk asset weakness would likely accelerate private investment demand for the metals as well. The ultimate question is whether Japan can engineer a controlled return of capital without triggering the very market dislocations that a stronger yen has historically accompanied. Past episodes demonstrate that rapid yen rallies rarely occur in isolation. They are both symptom and amplifier of stress elsewhere. This time the stress is being invited by design. The consequences will not be confined to Tokyo or to the foreign exchange desks of major banks. They will appear in American mortgage rates, in the clearing levels of treasury auctions, in the valuations of leveraged equity portfolios, and ultimately in the relative performance of assets that stand outside the credit system entirely. Gold and silver have occupied that outside position for centuries. The present reconfiguration of Japanese capital flows is simply the latest reminder of why that position retains enduring relevance.